Hey, stop scrolling for just 1 second. Before you fill out yet another online application that's probably going to disappear into some sort of corporate recruiting black hole, maybe try to consider something else. In the last episode, we talked about micro entrepreneurship, which is a small, low risk digital income stream that you can pretty much start around the kitchen table. But what if that's not enough for you? What if you have bigger ideals and dreams? What if the dream isn't just a side income? What if your dream is to have an actual business, a real business with a sign on the door, employees, a legal structure, and real money on the table? Maybe a storefront, a service operation, or a product that you manufacture or ship. That is what we're talking about today. Not micro entrepreneurship, but macro entrepreneurship, the full commitment. And I'm going to be honest with you in a way that a lot of business media isn't, because most business media, they focus on the upsides and the glory of entrepreneurship. It doesn't cover the work, the struggle, the failure, or the pain. I do cover that because you deserve the honesty to be able to make good decisions for your future. And I want you to know what it really takes before you bet your life savings on it. Here's a number that should stop you cold. According to the Kauffman Foundation, the highest rate of new business creation in the United States right now is among people ages 55 to 64. Not 25-year-olds in gray hoodies. No, us. People with gray hair, not gray hoodies, and 401k statements, and decades of expertise that nobody asked about in the last interview if we weren't even ghosted. And here's the part that makes me either angry or hopeful at the same time. A lot of these businesses are being started not out of some lifelong dream of entrepreneurship, but rather out of necessity. Because the corporate door got slammed shut again and again and again. So people are building their own doors, and that matters. But building a door and building a house are two very, very, very different things. Micro entrepreneurship is a door. You can start with a laptop and an idea. A full business, that's a house. It needs a foundation and plumbing and wiring and roof and somebody to maintain all of it. That's what we're going to walk through today. We're going to talk about the foundation, the frame, the door, the honest truth about whether you should be the one who's swinging the hammer in that project. But before we get into the mechanics of starting a business, let me ask you something. And I want you to really think about this. Are you cut out for it? No, not the idea of it, not the fantasy of being able to call yourself your own boss, but really the reality of this whole thing. Because there's a thing about starting a business after 50 that nobody talks about. You're not 25 with nothing to lose. You probably have savings. You probably have a mortgage or a rental payment. You might have a spouse whose income that you're going to have to lean on for a while. You have something to lose. And that changes everything in how you're probably going to approach risk. Let me give you what I would call the Tuesday morning test. So picture this for just a moment. It's Tuesday morning in, let's say, February. Your one employee just called in sick. The supplier has raised their prices by 12% again. And your biggest client is 45 days late in paying. And then your spouse or your partner comes and asks you if you're going to be able to make the mortgage payment based on the revenues that you're taking in. How do you feel right now? If your stomach just knotted up and your first thought was, wow, I can't handle that, then I want you to hear me clearly. That's not weakness. That's self-awareness. And self-awareness, it's going to save you a lot more money than any business class ever will. But if some part of you, even a small part, thought, okay, how do I do this? Then maybe, just maybe, you've got the wiring to take this on. Because here's what I've learned over the last 6 years of running my own business. Entrepreneurship, it's not so much about risk tolerance. It's actually more about problem tolerance. Can you handle a new problem every single day for years without burning out? Can you make decisions based on incomplete information and then live with the consequences of those decisions? Can you be the person who holds together an entire team when everybody is shaking? If yes, keep watching. And if no, there's no shame in that. Not everybody is wired for this. Let me be honest with you. This part now is absolutely the least sexy part of starting a business, but frankly, it is the most important. So let's jump into it because the legal structure that you choose ultimately is going to determine your personal liability as well as your tax implications. It's also going to have an impact on your ability to bring in partners and investors in the future. And if you get this wrong, it could cost you in the long run, not just the business, your personal savings, and your home as well. So let's walk through the four main options that are out there in terms of business structure. So let's walk through the four different options. I'm going to keep it more practical and less academic at this point. Option one is the sole proprietorship. That's the way I started off at the very beginning. This is pretty much the default. Uh, States in the United States, they might not even require paperwork. Some do, or at the local level. You'll have to check into that one. But let's just say if you start to sell something and you don't file any paperwork, pretty much by default, you're a sole proprietor. It's free, it's instant, it's simple. But here's the problem. There is zero legal separation between you and the business. If your business gets sued, you're getting sued, and your personal assets are all on the line. Your house, your car, your savings, everything. For a micro entrepreneurship play, the risk of this, it could be acceptable. But for a full business with employees and perhaps physical locations, that's like going into battle without wearing any armor. Don't do it. Then we have option two, the LLC or limited liability company. This is the most popular business structure for small businesses in America. I have my own LLC, for example, under which I operate all of my different business opportunities. And for good reason. An LLC creates a legal wall between you and your business and your personal assets. If your business is sued, your home, your personal belongings, all of those are generally protected. Now, I said generally, and I chose that word carefully because there's something that many people don't understand about LLCs. The legal wall, it is not made of concrete. It's made of paper. And if you commingle your funds, you pay for a personal dinner from your company credit card or debit card, and you don't hold the proper meetings and you don't keep clean records and financials, a court can actually pierce your wall and come after your personal assets. It's literally called piercing the corporate veil. And it happens more often than you might think. Setting up an LLC, it can cost you anywhere from 50 to 500 US dollars, depending on your state, plus annual registration fees. Some states charge $50 a year. Others, like California, charge 800. You should know your state's fees before you get started. Option three is an S corporation. This is not a separate legal or business entity. It's just a tax election. You can form an LLC and then elect S Corp when you file your taxes with the IRS. Here's why you might consider doing that. With a standard LLC, all of your profits are subject to self-employment tax, which is about 15% on top of your income tax bill. With an S Corp, you split your income into two parts. a reasonable salary, which is subject to payroll taxes, and profit distributions, which are not. For a business making $80,000 or more, this can potentially save you thousands per year. But here's the trade-off. S Corps, they require a lot more paperwork. You need to run formal payroll, you need to file a separate tax return, and you need to hold annual meetings and document those and keep those on file. If your business is going to generate real revenue, talk to a CPA about whether the S Corp election makes sense for you. And when I say CPA, I mean a person, not a YouTube video. Make sure that you get proper professional business advice. Option 4 is the C Corporation. This is a pretty heavy duty structure. It's what venture-backed startups use. It's what companies use that plan to go public at some point. For most of us watching this, it's probably an overkill structure. It involves double taxation. The corporation pays profits on its taxes, and then you pay taxes again on the dividends that you receive. But if you're planning to raise significant amounts of capital from outside, this structure allows you to do that, also to bring in additional members into the company. For the C Corp, I highly recommend that you talk to a business attorney, a real business attorney, not my cousin Vinny or something that you see on YouTube. Here's my bottom line on the legal structure. For most business owners over the age of 50, starting a service or a retail operation, an LLC is probably the right starting point for you. It gives you liability protection without too much complexity of a C Corp or an S Corp. You can always grow into one of those later. But whichever one that you choose, make sure that you choose it properly according to the needs of your business. You'll need to file the right papers in your state. You'll need to get an EIN, an employer identification number from the IRS. And you need to open up a separate bank account for your business. And for the love of everything holy, don't mix your personal and your business finances. Now let's talk about money. Not revenue, not profit, but accounting, how you measure your money. Because here's something that I've seen with people who are starting business for the first time. They confuse revenue with profit. They land their first $10,000 from a client and they think that they made $10,000. No, they didn't, because they had expenses, software, insurance, supplies, mileage on the car, maybe a contractor or some other service, maybe even rent. Your profit is what's left over after all of those things are deducted. And if you're not tracking all of that from day one, then you're actually flying blind. Here's what I want you to do to set up before you make your first dollar. 1, you open a separate checking account for your business. Not optional, not later, like right now after you file. 2, accounting software. Whether you choose QuickBooks, FreshBooks, Xero, choose one, learn it, or hire somebody who knows it and can do the numbers for you. 3, a system for tracking receipts. Every single one. You have to keep track of all of them. And I don't care if it's a $4 coffee that you bought one of your potential clients, track it. Because at tax time, those receipts are your deductions. And deductions, those can be real money. Number 4, a monthly financial review. Not quarterly, not when you feel like it, monthly. It has to be done. You have to sit down with your numbers and you have to ask yourself 3 questions. Did I make money this month? Where did the money go? And lastly, do I have enough cash to survive next month? Here's the thing about business accounting that not everybody tells you. It's not about being good at math. It's about, well, to be honest with yourself. The numbers, they don't lie. But business owners, we lie to ourselves all the time about the numbers. this expense, it's just temporary. This investment, it's going to pay off in the long run, or I'll make that one up next month. Maybe, maybe not. But the spreadsheet, it doesn't care about your sense of optimism. It just shows you where the business is and whether you're actually working or just subsidizing a hobby. And if you're subsidizing a hobby, you need to find that out after 3 months, not after 13 months. And I want to mention another one that can catch people off guard. Taxes. Yes, I know, the T word. They always find you, don't they? When you're an employee, your employer withholds all of the taxes in your paycheck. When you're a business owner, there's nobody withholding anything. You owe self-employment tax, you owe federal income tax, you might even owe state income tax. And if you don't set aside taxes every month throughout the course of the year, you're going to end up waking up in April and not have the cash to pay your taxes. So I want you to do this. Every time a client pays you, take 25 or 30% of that payment and move it into a separate savings account. Call it your tax vault, for lack of another word, because that money doesn't belong to you. It actually belongs to the IRS. You're just holding it for them for now. And trust me, they'll come looking for it if you don't have it. Now let's talk about a part of business that is simultaneously the most rewarding part, but also the most exhausting. People. Because at some point, if your business is going to grow, you can't do it all by yourself. And here's where I see a lot of the first-time business owners over 50, or anyone for that matter, making a critical mistake. They hire too fast. They land one big client, they panic about the capacity to work and finish the job, and then they hire someone full-time before the revenue can even sustain it. Now, they've got payroll pressure on top of everything else. So let me give you a framework for thinking about staffing. Think of it in 3 different tiers. Tier 1 are contractors and freelancers. This is where you start, okay? You hire someone for a specific task for a specific period. No benefits, no long-term commitment. You pay them for the work, and when the project is done, you go in separate directions, unless you have another project. This gives you flexibility without fixed commitment. Tier 2 are part-time employees. So when you have consistent work that needs to be done every week, every month, but not enough time to justify a full-time employee, then a part-time employee will fit the bill. Maybe 15, 25 hours a week, maybe remote, maybe on-site. But here's the part that some people might forget. Even part-time employees come with certain obligations. In many states, even when you have one employee, you need to pay workers' compensation insurance. You need to handle payroll taxes. You need to comply with all of the local and state labor laws. It's not just writing a check, it's a full-blown legal relationship. And finally, there is the third tier, which is indeed full-time employees. So this is the big leap because a full-time employee is a fixed cost. They get paid every 2 weeks, regardless of whether the revenue came in that week or not. And if you happen to be in the United States, a full-time employee typically means that you're also providing health insurance, paid time off, and potentially even some retirement benefits. That's not just salary. So a $50,000 salary can very well add up to $65,000 or $70,000 once all the taxes, insurance, and benefits are added up in. You need to know your fully loaded salary cost before proceeding with a full-time employee. And here's a question that you need to sit with for a moment. What is the single highest value activity in your business? The thing that only you can do, the thing that actually drives your revenue. Now, Everything else, everything else is a candidate for delegation. So if you're spending 15 hours a week on tasks that somebody else could do for $20 an hour, you're not really being scrappy or bootstrapping. You could possibly be just inefficient. Your time and your focus needs to be on something that's important and core to the business. But let me also be really honest with you here. Hiring people is emotionally heavy. When you have employees, their entire livelihoods, they depend on you. And that's not a small thing. That's quite a big burden to carry, in fact. You will lie awake some nights thinking whether you're going to be able to make payroll next month. And that's the reality. It's also one of the most meaningful things, though, that you can ever do. Giving someone a good job with fair pay and respect at a time, especially when age discrimination is so rampant and people are pushed out everywhere. That can be something to be proud of. Let's step back and look at the two big investments that you're about to make: time and money. And I want to be specific here because vague advice is basically useless advice. Let's start on the money side. The startup costs for a full business can vary widely depending on whatever you're building. And the service business, well, could be $5,000 to $25,000 to get it started. A brick and mortar location, retail, could be $50,000 to $250,000, depending on what you're building and before you even open the doors. Whether you have also a product-based business, you're going to need inventory, manufacturing, warehousing, and perhaps even shipping accommodations. So I can't give you one specific number because the businesses out there, they vary widely. But there's a principle I can share with you, and here it is. Whatever you think it's going to cost in your investment, multiply by 1.5. And whatever you think it's going to take to get you to profitability, multiply by 2. It's not pessimism here. It's just experience, because there are always costs that you don't expect. Permits that you don't know about and suddenly pop up, equipment that breaks, maybe your marketing campaign didn't work and didn't have any effectiveness, and slower ramp ups, they happen all the time on your way towards profitability. So before you invest $1, I want you to build what I would call a survival budget. It's not a fantasy budget. It's a survival budget. What is the absolute minimum that the business needs to stay open for 12 to 18 months? Not including some big giant corporate salary that you want to take. I'm talking about the minimum: the rent, the utilities, the payroll, the insurance, software, supplies, taxes, on and on and on. That's the number that is going to be your break-even point. And your personal runway, it needs to cover the gap between when you start and when you start to earn money through your business. If your business isn't going to break even for 12 months, then you need personally at least 12 months of runway for personal expenses. Not in your business account, in your personal account. Because the thing that breaks more businesses than bad marketing or bad product is something else. It's when the owner runs out of personal money and starts to drain the business. And the moment that you start pulling money out of your business for your mortgage or other personal expenses, that's when the business can't sustain it. And that's when you get into a business death spiral. Now let's talk about your other big investment, time. And this is where the over 50 conversation gets real. When you're 25 and you start a business, you can work 80-hour weeks for 2 years and you can recover from this. But when you're 55, maybe not. I'm not trying to say that you're fragile, but I'm just saying from experience that your health is everything. And at 55, recovery might not come that quickly. So I want you to think about your time investment a little bit differently. You're not 25 anymore. Plan for 40 or 50 hours a week in the first year, not 80, not 100. If your business model is based on you working 80, then your business model probably needs to be updated. It's probably wrong. You're going to need to then fix your business model before proceeding. And here's a time question that's more specific to our demographic. Do you have any caregiving responsibilities? Maybe an aging parent or a spouse that has health issues, or even taking care of grandchildren? Because those time commitments, they don't go on pause when you start a business. And I've seen too many people who underestimated the time squeeze and ended up neglecting important people in their lives for a business that hasn't even found its footing yet. So be honest about your time, all of your time, not just the time that you think you're going to give your business, but also the time that you need to give to the important people in your life. So because this is a self-proclaimed no bullshit channel, let's lay out the pros and the cons of starting a business after 50. No sugarcoating here. Let's start with the pros, though, on the positive side. Look, you build something that nobody can age you out of. Nobody can fire you for being 58 when you're the one who is writing out the paychecks. You're leveraging all of these decades of expertise, your industry knowledge, your professional networks, and pattern recognition, things that a 25-year-old can't compete with. Another pro is that you're creating jobs for other people. And in this economy for workers over 50, that's not just business. That's actually a mission. You also build an asset. A successful business has enterprise value. You can sell it, you can pass it on to your heirs, you can use it to fund your retirement, the way that a side hustle, frankly, can't be leveraged. And then there's the psychological part of it. Building something of your own after years of being told that you're past your prime, that does something for your soul. It rewrites your entire personal narrative. You stop being the person that was pushed out somewhere, and you become the person who's built something. And that really matters deep down inside. And now for the cons, because we have to talk about these. There's personal financial risk. If the business fails, you could lose your savings that took you 20, 30 years to build. At 55, you don't have those 20, 30 years to rebuild the savings that you lose. And at our age, there's also the complexity of health insurance. In the United States, leaving the corporate world, it means that you have to navigate the so-called COBRA or ACA marketplace. And that's typically $500 to $1,500 per month for reasonably decent coverage. And if you have employees, you might have to cover those as well with health insurance. And that's a significant expense. And then on the subject of time, there's that time away from your family and your life. The first 2 years of a business are going to consume your evenings, your weekends, and much of your normal bandwidth. Your spouse or your partner, they need to be on board, not just reluctantly, but really firmly standing behind your back, because they are making just as big a sacrifice on this journey as you are. You're also going to experience incredible stress and uncertainty. Some months are going to be fantastic, and some months are going to be terrible. And you need to be emotionally equipped for that roller coaster that goes in both directions. And not everyone is, and that's okay. And that's why we're here talking about these things, the pros and the cons, so that you can take the right decision for what's right for you. So here's what I'd like you to do this week. And yes, I'm back with the homework assignments. Just one thing. Write down your business idea on a single sheet of paper. Underneath it, write down 3 different numbers. What is going to be the cost to start? What is the break-even number? And how many months of personal runway do you have to get there? That's it. Just those 3 numbers. Don't file the LLC yet. Don't quit your job, and don't sign a lease for your business. Just get those numbers on a sheet of paper. Because frankly speaking, the difference between A dream and a plan is going to be numbers on a paper. And I promise you, once you see those numbers staring back at you in your own handwriting, you'll know whether this is real or just a beautiful idea that's going to stay a beautiful idea on paper. Both outcomes, go or no go, they're fine. It's a decision you have to make that's right for you. In the very near future, I'm going to have 2 episodes that are going to bring this entire topic to life. I'm going to be sitting down with 2 different business founders who have founded businesses in completely different fields. These are people who started businesses in their 50s and live to tell about it. Both are going to share their ups and downs, their insights with you. Their stories are true. They're very instructive. And both of the stories are going to help you to decide whether this is the right way to go for your case. You're not going to want to miss either one of those 2. So make sure that you follow the channel and subscribe. And if today's episode, if it helped you, please like the video, subscribe to the channel if you haven't already, and pass this along to somebody who might be sitting at their kitchen table right now wondering if they've got one more startup in them and want to get something going. And be sure to visit ageismsurvivalguide.com. That's my home base for resources that are downloadable, guides, things that I built to support you through every stage of your journey. And I'm also building a community on Discord, slowly but steadily. The link is in the description. It's still growing, but you're welcome to join in on the conversation. This is our time to rise. And as I always say, youth runs fast, but age knows the terrain. I'll see you next time.